In 2026, warehouses are outperforming almost every other type of commercial real estate in America. Rent growth on industrial property is projected to hit around 3% this year, the highest of any commercial property sector, beating office, beating retail, beating hotels. And yet, at the very same time, industrial vacancy is climbing to its highest level in years. So which is it? Is industrial real estate booming, or is it quietly falling apart? The truth is, it's doing both at once. And by the end of this video, you'll understand exactly why, and whether it still makes sense to put your money into it in 2026.
To understand where industrial real estate is headed, you have to understand how it got here. For most of the 2010s, warehouses were the boring, unglamorous corner of commercial real estate. Nobody made documentaries about distribution centers. Nobody bragged about owning a logistics park. Then two things happened at once. E-commerce exploded, and the pandemic broke the global supply chain. Suddenly, every retailer in America needed more space to store inventory closer to customers. Amazon, Walmart, Target, they were all racing to build and lease warehouse space as fast as possible.
Investors noticed. Demand for industrial buildings surged, vacancy collapsed to historic lows, and buyers were willing to accept razor-thin returns just to get their hands on a warehouse, betting that rents would keep climbing. For a while, that bet paid off spectacularly. Industrial rents and prices grew faster than almost any other asset class. But that kind of outperformance never goes unanswered. Developers responded the only way they know how, by building. Construction of new industrial space hit an all-time high, and by 2023 and 2024, all that new supply started hitting the market at once. That's the story of how we got from warehouses are boring to warehouses are the hottest asset in real estate to where we are today, a market correcting itself in real time.
So where does that leave us in 2026? Nationally, industrial vacancy has climbed to around 7.6%. That's a meaningful jump from the near-record lows of a few years ago. But here's the part most headlines miss. That number is hiding two completely different markets living inside the same statistic.
On one side, you have large logistics buildings, the massive 1 million square foot distribution centers, built for companies like Amazon and major retailers. This is where almost all the new supply went, and it's where almost all the vacancy is sitting today. Rent growth on these big box buildings has essentially stalled. On the other side, you have small industrial space, buildings under about 10,000 square feet. This segment barely got any new construction at all. Demand for it has stayed consistent, and it remains genuinely scarce. At the same time, new construction across the board has slowed dramatically. Builders started roughly 25% fewer new industrial projects in 2025 compared to the pre-pandemic average. That means the deliveries hitting the market in 2026 will be more than 70% below the peak we saw during the pandemic building boom. In other words, the oversupply problem is temporary. It's already correcting itself. Less is being built, which means today's elevated vacancy is more likely a speed bump than a permanent shift. The bigger picture? Industrial real estate isn't one market anymore. It's two. And knowing the difference between them is the single most important thing an investor can understand in 2026.
Let's talk numbers, because this is where "is it a good investment" actually gets answered. The most important number in commercial real estate is something called the cap rate, short for capitalization rate. It's simply a property's yearly income divided by its price. A higher cap rate generally means higher potential return, but also higher risk. A lower cap rate usually means a safer, more in-demand asset.
For large industrial warehouses in 2026, cap rates are generally running in the 5.5% to 7% range. That's actually one of the tighter, more consistent ranges across all commercial property types.
tighter than hotels, tighter than office space, which tells you something important. Even with rising vacancy, investors still see industrial as one of the more stable, predictable bets in commercial real estate. And here's the tailwind working in investors' favor right now. Borrowing costs are coming down. Financing rates that were painfully high back in 2024 have eased significantly, with typical loan rates now sitting in the 6 to 7.5% range for qualified investors. Cheaper debt means better returns on the same property.
That shift is already changing who's buying. Private investors, individuals, families, smaller investment groups are now responsible for close to 60% of all industrial property purchases. They're moving faster than the big institutional funds, getting ahead of the larger players who are still waiting to fully commit. So, by the raw numbers, industrial real estate in 2026 offers relatively stable, predictable returns in an environment where financing is finally becoming easier again. That's a genuinely attractive setup, but only if you're buying the right kind of building. Which brings us to the part of this video most YouTube channels skip. Remember that split we talked about earlier? Big box warehouses versus small industrial space? This is where it really matters. While everyone's attention has been fixed on giant distribution centers, small bay industrial, buildings under 10,000 square feet, has been quietly outperforming the big guys on almost every metric that matters. Lower vacancy, stronger rent growth, and far less competition from new construction. It's the segment that institutional investors, the big pension funds and REITs, are only just starting to notice. Which means for now, it's still a market where an individual investor can compete. On top of that, a newer model is gaining traction: co-warehousing, essentially flexible shared industrial space, similar to how co-working reshaped office real estate. Owners are using this model to fill vacancy in multi-tenant buildings and attract smaller, more diverse tenants who don't need or can't afford a massive standalone facility. If there's a single takeaway from this entire video, it's this. The future of industrial real estate isn't about chasing the biggest building in the biggest market. It's about owning the right-sized building in the right location for tenants who actually need that specific space.
Now, no investment video would be honest without covering the risks, and industrial real estate has real ones in 2026. First, oversupply risk isn't evenly distributed. Certain Sunbelt markets, places like Phoenix, Atlanta, and Dallas, absorbed a huge wave of new construction over the past few years, and they're still working through elevated vacancy as a result. Second, trade and tariff policy remains genuinely unpredictable. While the majority of industrial demand is tied to domestic consumer spending rather than global trade, shifts in tariffs can still ripple through specific markets and tenant industries.
Third, power and energy constraints are becoming a real bottleneck. Modern warehouses increasingly rely on automation and higher electrical loads, and in some markets, the power infrastructure simply hasn't caught up yet, which can limit which buildings are actually future-ready. And finally, long lease terms cut both ways. They provide stability, but they can also lock owners into outdated rent assumptions if the market shifts significantly during the lease term. None of these risks are deal breakers on their own, but they're exactly the kind of details that separate an informed industrial investor from someone just chasing headlines.
So, back to the question this video started with. Is industrial real estate still a good investment in 2026? The honest answer is yes, but selectively. The days of buying almost any warehouse and watching its value soar are over. The market has matured, and it's rewarding discipline over speculation. Big box, oversupplied markets require real caution, but well-located, high-quality, and especially smaller industrial properties remain one of the most fundamentally sound corners of commercial real estate today. Industrial isn't the flashy, effortless trade it was in 2021. It's something better for long-term investors, a market that finally rewards knowing what you're doing.
If this kind of breakdown helped you understand where real estate is actually headed, hit subscribe. This channel is where we cut through the headlines and get to what the data actually says every single week. Thanks for watching, and see you on the next one.